Chief Investment Officer with Mirae Asset Management joins us. Rahul, good morning. Thank you for joining us. It's been a very news-heavy period. Budget, credit policy, Rahul and Adani group of stocks, FIs are selling, and yet Indian markets have not broken down. Do you think rather than looking at the market underperformance, we should applaud it for the fact that despite so much of uncertain news, the Nifty or benchmark indices are still standing tall?
Absolutely, Nikunj. I think the economy is not doing that bad. So there is some bit of a slowdown, but from a relative growth perspective, also 5 to 6% real GDP and a nominal GDP of 10+% or around 10% is a good number. So I think that is what is being reflected. Look, what market is kind of paying a premium for is all the good action the government is taking. The budget wasn't really bad. Government, despite elections being 12 to 15 months away, stayed committed to fiscal prudence. So deficit was down 0.5%, committed to increasing capital expenditure by 20-25%. There were no specific handouts. So I think all that was taken positively. And as far as the Adani Group issue is concerned, look, most investors used to privately talk about it. Some of those issues have been highlighted. In a way, it's been a blessing in disguise that the issues have been highlighted now rather than 5 years later, where it could have been a much more systemic risk. Hopefully, everybody learns from it. I think the good thing is, unlike what happened in 9/12 when we had the likes of JPA go down and the domestic banks had huge exposure, right now domestic banking has very limited exposure. So as long as the group reforms in terms of the governance practices, the leverage, the pledges, etc., I think it should be a good learning from a medium-term perspective.
Yeah. One, do you think there is going to be no domino effect of what has happened in Adani group of stocks in other lenders and other NBFCs? Because the fear in the market is, like you alluded to, that this is an over-leveraged group, and if anything goes wrong here, it could significantly have an impact on the lender's books or the lender's balance sheet.
Prudent lenders, which definitely would not have an impact. NBFCs, again, I'm not sure. I'm going to be very honest here, because one doesn't know. The group's shares have done very well over the last 12 to 18 months. And typically, when the stocks do well, the tendency is to take a lot more leverage. There's a lot more room available for the pledge. So one doesn't know what are the pledges through some of the non-disclosed entities, etc. So it's only time what would tell us the true extent of the pledge and the coverage, etc. The hope is that there are some businesses which are good cash-generating businesses. They've committed to reduce the capex of the Adani port. Hopefully, that cash can take care of the leverage, and we should come out of this well.
Decline to buy any of the Adani Group stocks?
I think I'll wait for a while. Again, as we've discussed before, I'm one of the most conservative ones. The funds I run are ESG sustainable funds, so it would require a couple of quarters of effort in terms of disclosure, more on ESG, on governance rather than growth, for me to look at and buy some of them.
But Rahul, tell me, has this entire Adani episode, the stocks may do whatever they're doing and they're already in recovery mode, but has it somewhere sort of raised eyebrows and sort of tainted the India image, which was going just so well up until last year in terms of purely corporate governance standards?
I wouldn't use the word tainted. I think that's a bit strong word. But look, questions are being asked. So I was on a 2-week marketing trip in Europe. Almost every meeting had Adani question come up, and one had to explain what we just discussed before. What we've got to realize is, if over the next 5-10 years, India is becoming the third largest economy in the world, our large companies would be, in fact, most of our companies would be subject to a lot more scrutiny. And we saw that in time and again. Some of these short sellers come and write reports on the Chinese companies. Some of the reports were true, some of them were sensational. Look, markets took it at the strides. Wherever the reports were true, obviously the stocks got impacted.
Okay.
Right. Okay, let's move away then from the Adani names and where you're sitting right now. It seems like those are the markets which are sought after most right now, both China as well as HK. Wanted to understand whether purely on a relative basis, Rahul, is the India attractiveness easing off? Because other markets which have been stark underperformers for the last 2 years, they're clearly generating a high alpha.
Okay. So if I say what we were doing in our portfolio last year, I would say April, May, when everybody was euphoric about India. And look, it came in our funds also. We've been always overweight India. Last May, our India overweight in Asia funds were running 27, 28%. We were taking some money off the table because market were looking expensive. If you would have remembered, I was talking about the drawdown in reserves and the likely slowdown which was going to happen. This was a concern July, August onwards, whereas China was almost priced for bankruptcy levels. It was hated market. It was uninvestable. Pretty much like now. Now everybody is tired of India. Nobody wants to talk of India because China is making easy money. So I think that was the trade with China then. Now, if we talk, I think the trade is to take money off China, Hong Kong, China, and put that money in India. In fact, if you ask us what we've been doing in recent days, weeks, etc., that's something. Some of these Chinese names look fully priced for the reopening trade. Reopening is going to be a benefit of $100 billion in terms of consumptions. The internet names there, particularly the e-commerce names, have penetration levels which seem like full growth rates are going to slow down from here. So any long-term prudent investor from a medium-term perspective would book some gains in China on rise and look at a structural story like India to buy into tips. So I would be contrarian to what you hear most investors doing here.
When do you think money will come back into India? Because the economy is doing well, the budget has been great, inflation is speaking out, valuations are not that stretched. हमारा समय कब आएगा?
It would come definitely. See, what we have to realize is you make the maximum returns when people are pessimistic, when market participants are pessimistic, because that's where you get your good entry points. And 6 months later, as we keep continuing doing our job in terms of country, in terms of results, etc., and while other countries kind of struggle from structural issues, obviously people would realize that's the time to come back. But by that time, you'll get 20, 30% higher stock prices. So that means those returns would be lower from what we should see today. So any prudent investor should look to increase exposure now. I mean, we've been cautious about markets for last 12, 18 months with the premise that the Fed is hiking, things are going to slow down. I think worst of that slowdown is behind us. 6 months from now, narrative is going to be when does Fed eases. RBI also narrative would kind of a change now. Goods inflation is coming down. Service inflation is not much of an issue for EMs where kind of unemployment levels are high. So things should be much better in second half. So this is probably the worst of the quarters we've seen. Forex reserves also touched a lower 525 bill today as we talk, are somewhere around 560, 530 bill. It should get reflected in the growth numbers in the coming quarters.
Rahul, I distinctly remember we had this chat around insurance sector. That this is like a great phenomenal multi-year trend. But considering what the changes in the government policy making are, especially for the life insurance sector, do you think the story is getting slightly sour? One of the big factors which in a sense was driving the life insurance sales was tax savings. If that is off the table and if India is moving towards a new tax regime, will that have an impact on the life insurance sector per se going forward? And have you changed your view there?
Okay. So we've liked this sector from a medium-term perspective, and obviously government or some of the tax regime getting changed was a risk factor. So that's played out now, which is where stocks will take their time to digest this. Probably there would be a period of 12, 18 months where the growth rates would be limited, but the structural story kind of Indians being underinsured and this need for higher savings through insurance products remains. So it's a matter of time in a year from now when the growth rates return. And all these are good, well-managed companies. So we remain positive on the space.
You do have IT exposure. I don't know whether that extends itself into the new age fintech companies or not. But in specific, if I just talk about that cluster, they're turning around and sooner than anticipated. We saw it from Paytm, and hopefully Zomato as well should be doing the trick today when it declares its numbers. Area of interest for you?
Yeah. So we've liked some of these new age IPOs. I think Zomato and Nykaa was where we kind of initiated exposure when the stocks were down 50, 60% from hikes. Our point was, look, with good management, business models with strong headrooms for growth, some of these valuations were reasonable, or some of the pessimism about growth was baked in when the stocks were down 60, 70% from the highs. PTM, honestly, I've got to do more work over there. And why I say more work is because there's a credible bunch of peer set, which is the private sector banks, which is available. And those private sector banks for us are kind of a fintech giants of India, which are available a fraction of value of these new age fintech companies. A lot of these new age fintech companies are giving the loans, growing fast. Some of these loans are, again, in the underpenetrated categories, and you don't have much of a credit history over there. So it's easy to get excited over there, but one doesn't know what happens when the cycle turns bad. So which is why I'd rather play that through the established private sector banks where one has 10, 15, 20-year history of credit cycles. And if one wants to play at the new age internet exposure, look at the likes of Zomato, Nykaa for that matter.
Why just private sector banks, Rahul? The story seems to be in the PSB lot.
No, absolutely, absolutely. So again, private sector banks are more from fintech perspective, but look, the PSU banks are also going to do well. Look, this Adani episode slight blemish on the PSU banks, but the view is that the leading PSU banks are correct in their assessment and disclosures about their exposure to the group, and it should not cause serious damage, etc. But we continue to like the leading public sector banks like SBI, Bob, etc.
5% down for Adani Enterprises, 5% down for Adani Transmission. I think Adani Ports must have also turned volatile. Is it the MSCI impact, or these stocks had fallen so hard that a bounce was due? But when a bounce comes back, you will not. The stocks are not going to stabilize on a day or so, because the technical factors, demand, supply, promoter pledges, LAS, loan against securities, there are so many factors at play. And on top of that, the fact that Adani Enterprise and Adani Group will have to mathematically slow down their business. 20,000 crore of FPO does not come in. That was supposed to be done for Adani Enterprise. If that equity does not come in, obviously it will have impact on your future plans, green hydrogen, airport. Those businesses have to slow down, mathematically speaking, and that is something which markets will take their time to adjust and digest. So Rahul, before we wrap, give us a structural theme for 2023 and beyond, and give us a tactical trade which may have a shelf life of, let's say, 3 to 4 quarters.
Okay, so I think the structural theme continues to be financials. They're a best play on improving economy. Industrials are interesting here because, look, for the first time we've seen capex pick up. The government capex continues to be fairly high at 3.5% of GDP. It's moved from 2%. The spends are high. If the government capex continues to be this good and the economy recovers, private sector capex is going to pick up. So financials and industrials more medium term theme. And from a 3-4 quarter, autos look interesting. I think what's happened is if you look at the average age of the vehicles, that's about 8 to 9 years, particularly for four-wheelers. There's a strong replacement cycle coming in. There's a fair bit of an excitement with the new models being launched. And look, the sector is not that expensive. So autos from 3 to 4 quarters and industrials and banks from a medium-term perspective.
All right. Rahul Chadha, appreciate your time. Thank you so very much for joining us, and good to have you on the show. Trend is up 5%.